Hello and welcome to this edition of Here for Africa. My name is Charles Gitonga. Africa's future economic growth continues to be pegged on its ability to develop infrastructure linkages. Currently, the annual investment deficit in the sector stands at about $100 billion. In this story, we are going to highlight the different developments across the continent and the role of commercial banks. The African economy is set to grow by 4.1% this year, coming off a turbulent period occasioned by the crash of commodity prices, which started in 2015. The African Development Bank believes that the recovery is faster than envisaged, but the continent will need to make best use of scarce infrastructure budgets to foster and sustain inclusive economic growth. To understand the gaps in Africa's infrastructure, one ought to consider the following statistics. More than 600 million people are living without electricity. Over 300 million do not have access to reliable drinking water, and only 34% have access to good roads. It is therefore not surprising that the continent's annual infrastructure deficit has been placed at about $100 billion, and as a matter of fact, new work by the ADB places this figure at between $130 to $170 billion a year.
So that is a huge amount of investment that needs to go to address the shortages that we have had, whether it's in terms of our road network, our port facilities, our airport facilities, the energy sector in particular, where almost 70% of Africans do not have access to electricity. So there is a huge gap, and therefore I think a lot of governments have prioritized infrastructure spend, as well as obviously macroeconomic stability. I think those were two areas where we have seen African governments over the last 2 decades really focus their attention.
This infrastructure deficit is a sort of, if you will, the big elephant in the room. And it's going to take all of us working together to address it. By all of us, I mean governments, the private sector, IFIs like the ADB and other partners, commercial banks, and others to come together, join hands, and address it.
You know, the deficit that we have, and you know, in large countries like Nigeria, where you have nearly 160 million people, and where total production is about 4,000 to 5,000 megawatts of power. I mean, a comparison is the Narita airport in Japan, I understand, has a similar power capacity, just at the airport itself. So, that's quite a stark realization of the problem that we face on the continent. And it's something that, governments cannot fix by themselves.
African governments continue to embrace their role in development of infrastructure. In the year 2016, they invested an estimated $324 billion across 286 projects. But given the big sums required, authorities have been working towards credible public-private partnership frameworks.
The game has changed. The game has really changed. And it is no longer the government borrowing to build infrastructure. Today it's the government, the private sector, and the development partners coming together. Therefore, this notion that government has to borrow to build the roads, to build the transmission lines, is no longer valid. Today, there are private partners who are ready to come and build a transmission line in some PPP fashion. There are development partners who are ready to join in a special purpose vehicle, SPVs that finance these kind of things, SPVs that can assume both debt and equity. So there is now creative financial engineering taking place.
If I take a recent financing we did with the Development Bank of South Africa, DBSA, where we helped them raise $200 million through a MIGA guaranteed. So MIGA is the World Bank, it's called the Multilateral Investment Guarantee Agency. And MIGA basically comes and guarantees the amount of the loan up to various percentages, and the commercial banks come and structure it and then provide the funding against that guarantee. So it takes away partly from the risk of which country, whatever country they're looking at. And DBSA will use that money for infrastructure development throughout the region, specifically in Southern Africa, and really go a long way to help with a lot of these projects that are there.
Some countries such as Kenya and Nigeria have dedicated institutions towards this.
What we do in ICRC, our focus is to bring in the private sector, to bring in capital, bring in expertise to operate these facilities, and we have been very successful. One of the major projects that we have is the Lekki Deepwater Port. You know, and I mean, you know, I've got a picture of the Lekki Deepwater Port here for you. That's a $2 billion, you know, investment, you know, that will provide a world-class, you know, port that will develop our country. On the transportation area too, you know, the government of Nigeria is working with GE, you know, to bring in $1 billion to bring back the railway. Nigeria is a country of 180 million people, and we're not going to be able, you know, to move all Nigerians, you know, by cars. You know, we need to have rail, you know, to unleash the advantages that we have.
Stakeholders in the African infrastructure landscape reckon that the world is awash with capital. Institutional investors such as insurance companies, pension funds, and sovereign wealth managers have around $100 trillion in assets under management globally. Among the reasons why most of this capital is not coming to Africa is the inability of governments to meet demands of private investors.
Within the PPP model, there are different spectra. Even within the PPP, there are different flavors or different risk appetites tied to them. I think to the extent that we expect people to come in, design, build, operate, finance, transfer, and all that stuff over a lengthy concession period, I think within that framework there's usually some appetite, but again, it usually goes back to that viability gap funding, where the private sector is prepared to do something. That thing they're usually prepared to do is to match what government, the public sector, has put down. And for as long as you don't have the government putting down what this private sector can match, then you don't have a project that's going anywhere.
The continent is also yet to de-risk most of the infrastructure projects by developing them to a bankable stage.
There are many good ideas, but unless they're bankable, they remain a hobby. You know, good ideas, there are many good ideas. But the capacity to go from good ideas to developing bankable projects, I think this is a capacity constraint across the continent. I dare say East Africa perhaps has even a better capacity to do that. But there is always good capital, global and local, looking for good projects.
Every bankable project that has been done in Africa has raised capital. Capital has never been the problem. So we need to focus our energy on the right. It's first things first. And the first things first for us is to have bankable projects. You know, when you have bankable projects, like I said, whether it's commercial bank capital, you know, whether it's high net worth, you know, individuals, you know, you have a lot of money. After all, I mean, many Africans go and buy houses in Dubai. You know, they would rather invest in their countries if the opportunities were there. So the capital is not the problem. So whether it's commercial banks or high net worth individuals, or that capital is there. What we need to focus our energy, which is where the public sector needs to focus our energy for, is to create the capacity, the technical capacity to have bankable projects.
The political class on the continent also needs to invest in stability of policy and government transitions as a way of enabling comfort of private investors.
I think the biggest problem we have is the lack of institutional stability and continuity in government. Most infrastructure projects are long-term. We're talking of 10, 15, 20 years before you can get your return. Unfortunately for us, our political instability and lack of policy consistency have made things very, very difficult. That's why you hardly have long-term projects even being financed by Nigerian banks. Because a new government will always come and check what the last administration has done. So if we sign a deal of 20 years with a particular government, the new government come into play and say, oh no, we have to review this agreement. Or you can even have outright cancellations. So these are issues that made investors to be wary. Many
of our regions and many of our countries in Africa, we still have issues, you know, around some form of political stability, be it in the past or some that's being faced now, and therefore, you know, many institutions want to try and find a way around sort of the political risks that are involved. We also have nascent and in some instances, you know, a very less developed sort of framework for regulatory, legal issues and aspects. Because, you know, if somebody is going to come and put a lot of money for a power project or a port or you know, roads and other infrastructure, they do want the protection of the agreements that they sign to be held and to withstand you know, the test of time, because these are, you know, 10, 20-year agreements and projects.
In the recent past, African governments have increased their appetite for sovereign bonds to finance infrastructure projects. They sold close to $11 billion in the year to March, in addition to $18 billion raised in 2017. But the IMF is already raising the red flag as public debt on the continent exceeds half of the GDP.
Money that's being borrowed is being put in the right place. However, having said that, there's also a limit as to how much you can or you should borrow. The IMF has a debt sustainability issue, whether countries can borrow so much. So countries are approaching this very prudently. And I can tell you Kenya, for example, is managing its debt very prudently. Kenya is still within the acceptable zone of debt. But the government, the Treasury is very much aware of it. They're now looking at consolidation rather than new borrowing. But what is happening now is that it is time to begin having the infrastructure that we've put in place begin to produce. It's called sweating the asset.
At some point, I think, you know, when they do come out and they do these issuances, they are fitting within sort of their own debt profile in terms of how, you know, what parameters they want to see their debt, you know, the debt go to. So it is within a very sort of programmed approach, and I think it's a right way to move forward, because it is that private partnership. And, you know, the governments have to come and play in that field then to attract the private part of it. And, you know, and I think we're seeing, you know, good traction being made there.
With the borrowing space tightening and the ever-increasing financing needs, commercial banks are playing a crucial part in creating deals that reduce pressure on national treasuries.
So I think, you know, commercial banks have a very important role to play. If you take a look at ourselves as Standard Chartered Bank, I mean, we've been in Africa for over 150 years, and we feel that we know the markets really well. And therefore, it's sort of bringing in our local market expertise and capabilities, and then going and ensuring that we find the right partners, you know, globally, and bringing those partners here, and then packaging, for lack of a better word, a lot of these deals.
Given our international network, we've been able to leverage that in terms of supporting various infrastructure projects in Kenya, specifically in the area of energy. We've been very, very strong in partnering with stakeholders to support investments in the energy sector. We have also partnered with you know, stakeholders in terms of the railway, the SGR that was of course launched. We were one of the supporters in terms of providing services to the main contractor who was involved in that project. We've also been active in the telecom sector as well. We've partnered with some of the key players there when it comes to, say, towers that we are invested in over the last few years. So overall, our portfolio on the energy sector broadly across Africa is over $1 billion US. And of course, Kenya is a very, very significant part of that.
With a rising population, evident stress on public amenities, eyebrow-raising debt levels, African governments will need to employ a higher degree of priority in infrastructure development going forward. Reporting for CNBC Africa, my name is Charles Gitonga.